Hey there, my name is John Stevenson. Welcome to the Guaranteed Retirement Guy Show. Today we're going to be going over some top mistakes people make when withdrawing money from their retirement accounts. So if you're getting close to retirement and you're not wanting to make those mistakes and you're wanting to protect yourself, especially if you're looking for guaranteed lifetime income, I'm going to talk about that as well. But let's talk about the mistakes, okay? Because they can be substantial. The first one that I want to talk about is taking money out before 59 and a half. If you got an IRA or a 401k, you usually cannot access it until you're 59 and a half without incurring a 10% tax penalty. Now, it can be different if you got the 401k still sitting with the employer and you want to take withdrawals from it at age 55 and later. You can do that without having a tax penalty, but you have to leave it in there, okay? And that can be a problem if you're trying to put that money somewhere else that you can get a much higher growth from and higher income down the road, such as an annuity. And yes, I'll just kind of let you know, I do annuities. I sell lots of annuities, and I do it because people want guaranteed contractual income. And I'll show you an example here real quick, but I want to talk about these mistakes first. All right. Okay. So the second mistake, this kind of goes without saying, borrowing without a plan to repay. Yeah. A lot of people borrow from their 401ks during the 2008 crisis, during times when COVID shut everything down, people were borrowing. You have to have a plan to repay. And unfortunately, a lot of people just kind of took out the money and they just never repaid it back. That is a problem. And I know you know that. But it becomes very apparent when people get close to retirement and they're like, man, I wish I would have paid that back. Like, that's so important. And I know this is kind of common sense, but a lot of us, we have made mistakes and we want to make sure that we can fix those, or at least stay away from those as much as possible. And sometimes it's nice to hear someone just talk about it. All right. Okay. So let's talk about the 4% rule and following it blindly. So the 4% safe withdrawal rate, that was something that someone came up with like 30 years ago about how we could take 4% out. And as long as market conditions cooperated, that we'll never run out of money. Okay. But unfortunately, it's been debunked and it's been brought down to like 2%. And most of us were like, I can't live off of 2%. Even if I got $1 million, $20,000 a year, that's not the retirement I'm looking for. Okay. So following this rule blindly is not a good idea. But I'm going to show you how you can take out more than 4% and have it guaranteed for life. Okay. So we're going to talk about that. Ignoring the sequence of returns risk. That's important. Okay, because you might get out at the wrong time, out of the market at the wrong time. You might be thinking, all right, I want to get as much growth as possible. But if you happen to have a recession, and you get out and you take your losses, now all of a sudden you're jeopardizing the rest of your retirement. It's timing the market. And you can't do it. Like, sequence of returns risk really hurts you when you're trying to time everything. Okay, so ignoring that is going to cause a lot of problems. And again, I'm going to show you how to fix that. Okay. Another one is not accounting for inflation. So you might be thinking, all right, I'm going to take this much out and this is going to be my level amount for life. I should be good. But the problem is inflation will continue to tick up 2 to 3% every year. Okay. It doesn't care who you are. It's not going to sleep. It's going to go up. And so that's going to cause things to really pinch you later on. And so we're going to talk about that as well. That's really important that you plan for that. And one of the best ways to do that is leaving money in the stock market, but you can't leave all of it in the stock market all the time, in my opinion, because you need some guarantees. It comes from contractual guarantees. A poorly timed Roth conversion. I get a lot of questions about Roth conversions, especially when people are buying annuities. And some annuities will allow you to do a Roth conversion after purchasing them, but there's only a few of them that will allow that. And a lot of times people are like, well, I want to take income in a year and I want to do a Roth conversion. And like, that could be a problem because you got the 5-year rule. You got to wait for that. And then you got to think about the break-even age. Okay. You're paying a ton of taxes right now. And yes, you're going to get tax-free income, but where is the break-even? Sometimes it's like in your 80s and you're like, oh, that's not worth it. And sometimes it's not. Okay. So these are a few mistakes that you're going to make, hopefully not make, but people do make them all the time. Another mistake I want to talk about is the RMDs. Yes, required minimum distribution. I talked to a guy like yesterday and he had no idea what these were until just recently, which I felt bad for him because he has this money he's been saving forever. And he's like, wait a second, I got to take money out at a certain age and I have to take it out at a certain rate and it goes up higher. I'm going to deplete all my savings. But unfortunately, that is the rule with a 401k, IRA, any of these tax deferred accounts. The IRS wants their money. They want the taxes. And so they let you defer it for so many years and then they make you withdraw it at a certain rate. And it may not be advantageous, especially for having you, enjoy lifetime income. That's guaranteed for life, no matter how long you live. Okay, that longevity risk is really, really important. So the longevity risk is the last thing I want to share, because that is the one risk. We don't know how long we're going to live. Some of us think we're only going to live till our 80s. Some people think we're going to live till our 90s, but a lot of us don't realize we're going to live a lot longer than we were planning on it, because just people are living longer right now. Okay. That's just what's happening. So I love to help people with solving all of these problems. And one of the biggest ways you can do it is through an annuity contract, because annuities give us lifetime income guaranteed forever, no matter how long we live. If we live to 110, we get it. I love that. Okay. They give us usually a higher withdrawal rate than 4%. Okay. Like maybe 6 or 7%. That's great too. And that's guaranteed for life. And you're probably thinking, well, how does that work? That's no way that'll work, John. I'm going to show you on my screen. Yes, it does work. And if you don't take my word for it, go to my website, johnstevenson.com, look at the annuity payouts. These are from reputable companies. Some of them are around over 100 years. Okay. Annuities have been around for over 500 years. Okay. They're not new. They are contracts. They are for guaranteed income, and they are great. And you don't have to use all your money for it. You can use some of your money for it. Okay. Some of your money for your guarantees, use the rest to leave in the market if you want, and let it grow. Okay. So I'm going to share my screen. Let's just talk about this. All right. So I put in $600,000, a married couple. They're age 60, but they're going to take income at age 65, and they want to get as much out of their $600,000 as possible. So let's take a look. So you can see right here, F&G. Let's see. This is single payout. Single payout for a male is $66,000. Okay. Well, they're married. We want to make sure it lasts for both of their lives. Okay. Let's go down. We'll look at that. Okay. $62,000 with Nationwide. F&G doesn't pay as much for the joint payout. So let's go back up and we'll say, all right, well, Nationwide does pay out the highest. That's really important. So $62,000. Here's a withdrawal rate right here, 5.95. Way better. Way better than 4%. And look at it if you wait a year, even a year, it's 5%, better than 4%, and it's guaranteed. And it's multiplied by $800,000, not $600,000. Isn't that nice? That's because the annuity contract sat there for 12 months and they gave you a guaranteed growth rate. They gave you 25% base bonus and 8% roll-up rate on top of that. And if you let it sit there for longer, they're going to give you that 8% simple roll-up rate every year for up to 10 years. That's pretty good. So you go over here and say, all right, well, if I let it sit for 5 years, that $600,000 turns into $810 at the end of the first year. And then after the end of 5 years, it's $1 million guaranteed, multiplied by 5.95. That's just because they let the insurance company have it for that long period of time. So because of that, those amounts multiplied against each other give you the $62,000 guaranteed joint income for life. That's really that simple. And it's just because you let it sit with the company longer. If not, you're just going to take out a payout that's less. I mean, if I were like, well, I need income right now, and I'm 60 years old, and I'm married, it's $39,000. Prudential will give you $39,000 the rest of your life. Okay, still pretty good payout. It's just not going to be as much. So if you want to wait till 62, still going to be more. It's not as much as age 65. So still $47,000. It's not bad. So it's just because you let it grow. And Clear Spring, they actually give you 8% as well per year. And that grows to $755 times 6.2, giving you this. So again, this is why I like annuities, because the payout rates are higher. The amount that they use is higher than your account value. And when you multiply them together, you have high lifetime income. So anyways, it's totally up to you how you want to set things up for yourself. But I have a lot of people that reach out to me for annuities for this very reason. They want to make sure that they do not run out of money. They want to make sure that they don't have any withdrawal problems later on. Because a lot of times we will try to time everything just right, just hoping that the money doesn't run out. But in my opinion, it's a lot easier and a lot less stressful if we have annuity contracts in place that are just paying us and we don't have to worry about it. So anyways, it's totally up to you how you feel about that. But if you are looking for an annuity and you are thinking, hey, I'd love to have one as part of my portfolio, then book a call. There is a link below this video. It goes directly to my calendar and we can get on a Zoom call and I'll show you everything that's available. If you want to go to my website, check out the annuity payouts and then book a call there as well. That's johnstevenson.com. You'll notice that I show everything that's available, okay? Some of them pay me high commissions, some of them pay me low commissions. But in my opinion, you should just pick what's best for you, and then the advisor should sell it to you. So it's a lot better than an advisor trying to show you 2 or 3 options that they like the most because they get paid the most. So it's not a great way to do business. Anyways, I hope this has helped. I really just try to be as transparent as possible, show you what's available. I really don't care if people buy annuities. If they want it, great. If they don't want it, then fine. If you do want it, I'd love to help you. So anyways, it's that simple. If you like the video, make sure you like, subscribe, share. If you have comments, comment below. I'd be happy to answer them. Otherwise, we'll see you next time.